This is a very strong jobs report today in the United States. Payrolls increased by 255,000 on the month. That's well ahead of analyst forecasts and suggests that the labour market is really back on track. In May, there were some concerns about weaker job numbers, and there were some worries within the Fed Reserve. Janet Yellen expressed them at the time, the chair, that the labour market may be losing some of its momentum. However, those concerns have really been assuaged by the latest two job readings, and so it appears that the labour market recovery, which has really been the benchmark, the underpinning of the US economic recovery, is fully back in sway. Wage growth was respectable in the month, but by no means buoyant. Average hourly earnings rose 2.6% on the year. That's in line with the previous month's reading, but still a fair bit below the sort of wage growth that we saw before the crisis, when readings were above 3% fairly regularly. So the Fed, I think, will want to see more evidence of firmer wage growth if it's to become convinced that all of the slack is eroded in the jobs market. Well, the labour market is front and centre within Fed deliberations as to when to raise rates again. And the weak numbers back in May had certainly prompted a lot of policymakers to want to go slow when it comes to a second rate increase. These numbers will be encouraging to Fed policymakers, and coupled with a number of other indicators within the labour market report, do suggest that the economy is on a pretty good track. Certainly jobs growth above 200,000 is easily enough to keep the unemployment rate low and stable. It held at 4.9% in the month, which has to be fairly close to full employment for the United States. So the Fed will look at these numbers and probably say that the possibility remains open now of a rate increase this year. The question mark really is whether an increase in September is possible, and that will depend on the next jobs report and really the other data that comes through, as well as the conditions in financial markets when policymakers next meet.